I believe that eventually around after 2050, maybe it's 2055, Bitcoin becomes the unit of account. And what happens is I sort of put a price of about 85 million on Bitcoin based off of just monetary debasement, total global store value assets growing, Bitcoin only getting 20% of the global store value assets, which is like insanely conservative. But then there's the big jump when I believe everything will become repriced in Bitcoin.
Yeah.
And that's what people they don't comprehend. It blows their mind. In theory, they're like, oh yeah, eventually Bitcoin will be the unit of account. Eventually everything will be priced in it. But what does that mean? Like, let's put a number to that. Right now you see a chart. Jesse put it out first. Michael Saylor uses it a lot, the $900 trillion of store value assets. But that pie continues to get bigger.
Mark Moss emphasizes that global liquidity cycles have a crucial role in determining asset prices, stressing that liquidity is more important than Bitcoin's halving occurrences or on-chain measurements. Financial systems are impacted when governments and central banks use monetary policy changes, stimulus, and debt issuance to manipulate markets. With a new U.S. administration now in power, we are seeing the consequences of past policies unfold in real time. Volatility is increasing, and markets are bracing for shifts in liquidity. Understanding these cycles is key to navigating the evolving financial landscape. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Thank you, and enjoy the video.
4 distinct phases of that cycle, and I believe we're in the second phase right now. So the first phase, and again, if you overlay like a diffusion of innovation chart, but in the first phase is that eruption phase where it's like, hey, this is the new thing. What the heck is it? Very speculative. What happens as we move to phase 2, we move into, and again, if I laid a diffusion of innovation chart, you have the innovators and the true believers, and then you have the early adopters. And so that's sort of what we call the frenzy phase. And so now this is represented by the institutions coming in, the sovereigns coming in, the Michael Saylors trying to gobble up Bitcoin as fast as possible. Like, the frenzy is here, right? We were talking about a publicly traded Bitcoin company called Matador that I'm a officer of. And so we're seeing these companies popping up, and we're just trying to gobble as much Bitcoin as we can. It's like a frenzy. And it's way bigger than the retail. Right? We're not talking about thousands or tens of thousands or hundreds of thousands. Now we're talking about millions. We're talking about billions of dollars coming in. And if you look at it like an S curve, the way that you use an S curve is the time it takes to go from 0 to 10% adoption is the time it takes to go from 10 to 90% adoption. So the second phase is like the parabolic turn. So that's where we're at. We're moving into that. We can see the states in the United States. We can see countries starting to adopt it. We saw the UAE, I believe, announced like a $400 million Bitcoin holding or purchase. And so we're seeing this frenzy happen. That's where we're at. And so the reason why I think that's important to understand is the makeup of the market is different. So the crypto space has gone straight meme coins, and over the last couple of weeks, it's just like dead. Like, people just hate it, right? And so that's just a part of that's how this works. That's part of the cycle, right? So this is all part of the cycle. This is how it goes. Like, I've been there, done that. So we're in phase 2. We're going into this frenzy phase. We see the sovereigns coming in, but the thing that I just want to encourage everybody at this point is that what happens for most people. Humans are horrible investors. We don't have the right lens. We use emotions. But one thing that typically people do is they always look in the rear view mirror. So Bitcoin's too expensive. Too expensive compared to what? Compared to where it was 5 years ago, or compared to where it will be in 5 years from now. And so we want to be looking in the windshield, not the rear view. And so what I would just say is, like, in the second phase, which we're in now, the second phase, that's where the most of the growth happens. That's where the S curve turns parabolic and goes straight up. I believe that through the end of this 50-year cycle, looking at all of these factors put together, and there's a lot of data behind that, I believe that eventually after 2050, maybe it's 2055, Bitcoin becomes the unit of account. And what happens is I sort of put a price of about 85 million on Bitcoin based off of just monetary debasement, total global store value assets growing, Bitcoin only getting 20% of the global store value assets, which is like insanely conservative. But then there's the big jump when I believe everything will become repriced in Bitcoin.
Yeah.
And that's what people they don't comprehend. It blows their mind. In theory, they're like, oh yeah, eventually Bitcoin will be the unit of account. Eventually everything will be priced in it. But what does that mean? Like, let's put a number to that. Right now you see a chart. Jesse put it out first. Michael Saylor uses it a lot, the $900 trillion of store value assets. But that pie continues to get bigger. as we continue to have monetary debasement and inflation, the denominator keeps pushing that basket bigger, bigger, bigger. And just at the current rates we're on, which, by the way, as I said, the CBO projects it to go up like a hockey stick. But if we just chart the same path, that puts global store value assets in 2050 to about 8.5 quadrillion.
You can't slow the money printer, that's for sure.
Yeah, we're not going to stop the money printer. So it's like, it's not like Bitcoin has to take all 900 trillion. No, it's the pie keeps getting bigger. Bitcoin keeps getting a bigger piece of it, but the pie keeps getting bigger. So we're 8.5 quadrillion. Bitcoin gets 20% of that, but then it's the repricing phase. Now, back to the question, like what are some things that could hamper it or hold it back in the short term? Well, what I would say is that from a macro lens, we think about Bitcoin in terms of hodl waves, or there's any number of indicators, SOPR, NUPL, or Puel multiplier, or whatever, right? And those are all really important metrics to look at, or indicators to look at. But I think overall, more important than even the Bitcoin 4-year halving cycle is really the global liquidity cycle. That's what matters the most over anything. And so I spoke at a conference in January, and I was just saying, I said I believe the first quarter of this year is going to be very volatile. You mentioned a new administration taking over.
Mark Moss highlights that when it comes to asset pricing, it is more crucial to comprehend global liquidity cycles than Bitcoin's halving occurrences or on-chain measurements. The primary force behind market swings is liquidity, or the movement of money into and out of the system. Through significant stimulus, debt issuance, and policy changes, governments and central banks have significantly impacted the markets in recent years. Now that a new U.S. government has taken office, we are seeing the full effects of these previous choices materialize, which has caused the financial system to become more volatile and uncertain. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
And the previous administration did a lot to goose the market, to manipulate the market, if you will. And the Trump administration took over a new administration that's just full of landmines. So, for example, because the Fed wanted to stay in a quantitative tightening cycle, Janet Yellen at the Treasury just completely front-loaded the front end of the Treasury issuance. So now the new administration all of a sudden has, was it like $6 trillion that they have to deal with and get refinanced? Whoa, that's a big problem. Number two, what Janet Yellen did again to sort of front run or circle around what the Fed was doing was drain the TGA, the Treasury General Account. So now they got that and it's like basically emptied. And so like these were things that we're doing to keep the market going, and all of a sudden now it's like, well, shoot, now we have no money. They did, the debt ceiling debate that gets recycled every year. They negotiated to push it. Well, let's not talk about that until January of 2025. Yeah, right when Trump takes over. So like we have all these issues, a new administration, plus like some serious issues that have to be dealt with. And I think that's just going to cause a lot of problems. Not to mention now, Trump's coming in and really trying to play the art of the deal and threaten tariffs with all of these nations. And it's all going to work out, man. It's all going to work out. Number going to go up, but like now, which nation's going to move first, and who's going to ease their, ease, and who's going to tighten, and what's going to happen. So we're in this period where global liquidity is sort of stalling out. I think it could take this first quarter. Maybe we have another 30 or 40 days, and I think things will start loosening up. And I think that money spigot's going to come back on. So I'd say that's like probably the biggest thing that would hold it back or hinder it, is that these things take longer. They don't get worked out in time, and the global liquidity sort of sputters a little bit, and it doesn't pick back up. Ultimately, it will. And if you have a long-term view, if you're thinking 5 years or forever like me, but even on a multi-year lens, it's like, almost bad news as good news. The worse things get, the more liquidity they're going to need later.
Absolutely.
An ounce of prevention is worth a pound of cure, right? So the longer they wait, the more it's going to cause problems, and the more the knee-jerk reaction will come, and it will blow this thing even higher. But I would say that's the number one thing that I think everyone should be focusing on, to really think about the short term and what would hold it back. I've been in maybe a contrarian inflation bull for a long time, for years now. I think that even at the 6, 7, 8% inflation that we had a couple years ago, like I was saying, that's still going to be some of the lowest inflation that we'll have. Now, I think it's important to understand, how do we measure inflation? So just to hit on that really quickly, obviously the government's given us a CPI number, or CPI, right? It's an inflated number. It's a manipulated number. And that's another thing the Trump administration took over, is all the data that the Biden administration was putting out was fake. And so now we're having to deal with real data. So that's a problem. But if we're looking at CPI, whatever they want to call that number, 3%, they're telling us that Americans' health insurance has dropped by whatever it was, 25% last. It's like, no one's seen their health insurance drop. That has not happened, right? So it's a manipulated number. I think of more of the Austrian number, which is the rate of monetary debasement. So that's what I'm going off of. And that's what, back to that whole presentation I gave at MENA, I was using that number. So I think that because we're in a debt-based monetary system, money is created through debt issuance. It's a Ponzi. You have to continue to grow the monetary base. So you have that right off the bat. You have monetary debasement. Number two, sort of back to the tariffs, I've been talking about now for about 5 years, back to how technology takes us from centralizing to decentralizing, how the world is starting to break apart. And when I first started talking about this in 2020, 2021, people thought I was crazy because the World Economic Forum was like getting bigger and bigger and bigger, and everything was going to be under Klaus Schwab, and the whole world was going to be ruled by the IMF and the BIS. And now we're seeing that the world is breaking apart. And so we're going more into like protectionism, and instead of just-in-time supply chains, it's just like, just in case I should keep all this stuff here. And so as all that stuff happens, competition starts to happen. Things are going to slow down. We have the United States now. Biden was pushing this, and now Trump is carrying it on, of like, hey, we should onshore, we should bring back our manufacturing base, onshore it or nearshore it. So when we offloaded or offshored our jobs, it brought deflation. And when you bring them back, it causes inflation.
In his conclusion, Mark Moss highlights the larger picture, stating that monetary devaluation and global liquidity cycles have a greater influence on asset prices than Bitcoin's halving occurrences or on-chain measurements. He draws attention to the ways in which central banks and governments control markets through debt issuance, stimulus, and fictitious economic growth. But the truth of these earlier measures is now emerging as the financial system stabilizes. He notes that there would be significant financial difficulties with the incoming U.S. administration, such as large debt refinancing and depleted government coffers. Short-term uncertainty is brought on by these pressures, rising inflation, and geopolitical tensions. Moss contends that these economic forces will eventually compel central banks to add even more liquidity to the economy, which will raise the value of assets like Bitcoin. Additionally, he questions conventional measures of inflation, contending that the published CPI figures are inflated and do not accurately represent the cost of living. He believes that the true measure of inflation is monetary debasement, or the growth of the money supply. Prices will probably keep going up as governments adopt protectionism, reshoring production, and enacting tariffs, which will support long-term inflationary trends. Moss leaves viewers with a crucial lesson. The market will react more strongly, and more liquidity will be required if the economic situation declines. The long-term trajectory is still apparent, despite the anticipated short-term volatility. Monetary devaluation will continue, and assets like Bitcoin will profit from the inescapable liquidity injections. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.